Good afternoon, everyone. My name is Trisha Praley, and I'll be talking to you today about your taxes. I'll do my best to make it interesting. A little bit about my background. I'm a certified financial planner. I'm also an enrolled agent, which is a tax professional license granted by the IRS. I'm also very passionate about helping people understand the financial situation, including tax planning and prep. And I really do hope that everyone will walk away today with something that they can use either in their own or the client's circumstances. First, a little disclosure. Everything I'm talking about today is for informational and educational purposes. It's not meant to provide any legal, financial, or tax advice. Everyone's situation is unique, so I suggest that if you have any questions, you can ask me or you can contact your own tax advisor. So next, due to the limited time we have, this presentation is geared to provide general awareness of taxes. It's basic tax information at a higher level. And it makes it difficult to cover too much. So there are some things I may have left out that could be pertinent, but for the most part, I'm hoping to cover everything today. As I said, it's going to be a high-level overview, talk about a little bit about what's taxable income, a difference between a deduction and a tax credit, and hopefully that will leave you with something that you learned today. So, how do taxes make you feel? Are you like this person hiding, peeking, please go away? Someone who is like stunned, can't move, deer in headlights? Or are you like this person, all nervous and shaky or overwhelmed? Or are you like this person? Yay, tax season. Well, don't worry. You may not turn into the excited person in the middle, but I will hopefully get you a little less like the people on the outskirts there. So starting with the tax overview, what is taxable income? So, and we all say that any money you earn, basically, Uncle Sam wants a piece of it. But there's earned income and unearned income. So earned income is just like it sounds. You earned it, you worked for it. Usually you work for an employer, you get a W-2 at the end, they take taxes out. You could also be working for yourself or as an independent contractor. In those circumstances, you're not having taxes taken out, but still earned income and still needs to be reported. Versus unearned income. Unearned income is more passive. It's basically, yes, you do have to pay taxes on it. You did earn it, but you didn't actively earn it. So this is like your bank account interest, dividends, capital gains or losses on investments. It can also include unemployment compensation, rental properties, gambling winnings, one-off payments. All of that would be considered unearned income. Now, most people look to the taxes and wish to get a refund. Common knowledge will say, well, getting a refund is like giving an interest-free loan to the government. So they're okay with giving you a refund and giving you just what you're owed and nothing more. However, for some people who owe a lot of money, the government says, well, you were holding my money for all this year, and they want a little bit more than what you owe them in interest and penalties. So there's something called a safe harbor. And again, the general overview is that they can't just owe the government thousands of dollars necessarily. So there's two factors in the safe harbor. One is you owe less than $1,000, no big deal, you pay that. The other is you need to have paid either through estimated taxes or through withholding at least the lesser of 90% of your current tax bill or 100% of the prior year, unless you are a high earner where it would be 110%. Now, what does that really mean? So here's an example. In this example, your current year tax liability is $60,000. And when I say your current year tax liability, I mean how much taxes are due before you even consider how much have you already paid. So think of what you paid either through withholdings or estimated taxes, which we'll get into in a bit. Consider what have you paid as like a down payment. Just because you put a down payment on a house doesn't mean the house costs you any less. So basically, you need to pay at least 90% of your current bill, which is 54,000, or 100% of prior year. So maybe prior year your bill was 45,000. So to avoid paying additional money beyond your taxes, the choice here is you would have had to owe less than 1,000, or you would have had to the lesser of these two, which happens to be 45. So what does this mean? It means that this year your tax bill is $60,000. If you only paid 35,000, well, that's less than 45, and you owe additional interest or penalties. But this year's tax bill is 60, and say maybe with the withholdings, you withheld up to $48,000. Well, guess what? No big deal. You don't owe anything additional in interest and penalties. You still owe your money, but they're not going to say, well, you were holding my money for the last year and we wanted it more timely. So that's all it means about the safe harbor. So you heard me mention estimated taxes. So estimated taxes is required if you will have a large tax bill. It's normally required if you are self-employed because no one's paying taxes on your behalf. So you need to make sure you're paying taxes on your profit throughout the year. Some people earn a lot of money, maybe in investments outside of the regular work, and therefore they would also owe estimated taxes. So it's really if it's mainly because you're not having enough withheld at work, then you need to talk to your company and try to get that rectified. But estimated taxes normally is because you have other income that's not considered and you need to pay taxes on that income in a timely manner. So with estimated taxes, there is 4 different time frames to pay. They're not evenly split in a normal quarter. It looks like at the beginning, but your first period is due on April 15th, and that covers the first quarter of the year. Second payment is due on June 15th, and that's for only 2 months. Then this third payment in September for another 3 months, and then in January for the last 4 months. So if you are subject to estimated taxes, you would need to be aware of these dates to make sure they're paid timely. Next, I want to talk about how maybe your taxes can be lowered. So a lot of times we see what our income is, but we may be able to have deductions to make our income lower. So there's tax deductions and tax credits, and they are not the same thing. A tax deduction reduces your taxable income, lowering the amount that will be taxed. Whereas tax credit will wait till your tax is assessed on you and then reduce that tax owed dollar for dollar. Generally, tax credits are more beneficial than deductions. And I'm going to show you an example of how that could be. So in this example, we're going to say there is $1,000 either deduction or credit. You get to choose and $1,000 for credit. And $1,000 less than $1,000 leaves you with 14. At a tax rate of 10%, that's $1,400 of taxes. But if it was a credit, you still had a taxable income of $15,000, a tax rate of 10%. Now your taxes are $1,500. But then you get to take the whole $1,000 as a credit against the taxes, and now your net tax is $500. Now, not to say that there's not circumstances where it might not be the same case, but for the most part, the credit will be more beneficial to take than a deduction. Next, so what is a deduction? What deductions are available out there? Well, one deduction is for educators. If you or your clients are teachers and you're bringing supplies into the classroom, which we know a lot of teachers do these days, so there's not enough in the budget. So if they're bringing in supplies to their classroom, they can deduct those supplies, but it's maxed at $300. So if they spend $250, they can deduct $250. If they spend $800, they can only deduct up to $300. Again, this is lowering your taxable income. Next one is health savings accounts. Now, there's a lot of criteria to a health savings account. And now most people do have this on their payroll being deducted out. So this does not apply there. This is for non-payroll contributions. It's when you actually contribute to your health savings account outside of your payroll for one reason or another. This could be because you're still covered by a high deductible plan, maybe not working at that company, you still have the account. It could be that you're married and you each have your own health savings account, but it's all under one plan. And so it's not coming out of your paycheck. So if you did contribute within the parameters of health savings accounts, which again, limited time here, so I can't get into everything, you would be able to deduct that from your income. Next is alimony paid. Up until through 2018, any alimony that was paid or received was taxable. So if it was paid, the person that paid it was able to deduct it, and the person that received it had to take it as income. Now that all changed, that if the agreement was dated on January 1st, 2019 or later, that's no longer the case. It's no longer income to the person, nor is it deductible by the person who paid it. But if it is an agreement prior to 2019 and there's still alimony going on, any alimony paid could be a deduction. The self-employment taxes, what they are is when you're working for yourself, you are responsible for your own taxes. And part of those taxes include the FICA and Medicare tax that we normally pay. When they say self-employment taxes, they're not talking about all taxes, they're just talking about the FICA and Medicare pieces. When you work, your employer pays the same amount of FICA and Medicare that you pay, but you don't see that because it's coming out of their pocket. When you're self-employed, you need to pay both pieces, but they allow you to deduct the employer portion within a certain calculation. It's not exact, but they let you take the employer portion and deduct it. So that would be a deduction. The other thing that's a deduction is if you are self-employed, you have your own self-employed retirement plan, you can deduct that as well from your income, as can traditional IRA deductions. Now, I don't like to say blanketly that traditional IRA deductions can be deducted because there are limitations. If a person is covered by a workplace retirement plan, an active participant of such, traditional IRA deduction, depending on what their income is. And that gets a little deeper, but I want you to be aware that traditional IRA deductions in general are allowed to be deducted, but there are limitations. The other one, I know that a lot of people here have armed forces, individuals in their constituency. When a lot of people, when they're PCSing, they will get reimbursed for their moving expenses, but I'm sure there's sometimes it may be on a personal move, they are not reimbursed for all of their moving expenses. If that is the case, as long as the moving expenses are within the IRS definition of allowable moving expenses and they weren't fully reimbursed, they can then take that as a deduction from their income. But it has to be not reimbursed and it has to be within the parameters of what the IRS defines. Again, it's only for armed forces, it's not for a relocation of a job. Then there's the qualified business income deduction. This is a deduction for self-employed businesses and partnership income. It's a little too detailed to discuss in this presentation, but I wanted to bring it to your attention. And if it should be relevant to you, then I would suggest that you just take a deeper look into it to see the qualifications and if you do qualify for it. And then, of course, there's a standard IMS deductions. We always hear about standard versus itemized. So in general, itemized deductions would include medical expenses that exceed 7.5% of your taxable income. It would include state and local income taxes and property taxes. It would include mortgage interest and charitable donations. However, as of what's called the Tax Cuts and Jobs Act of 2017 that went into effect for the tax year 2018, they capped how much in state taxes you can deduct, and that is capped at $10,000. In exchange, they also increased the standard deduction tremendously. And because of that, a lot of people that used to itemize are now taking the standard deduction. So you need to evaluate whether the itemizations that you can do would exceed the standard deduction. And if they don't, most likely you would take the standard deduction. There are some unique cases where they would not take it, but for the most part, if the standard deduction exceeds your itemized deduction, they would take it. Next slide, I'm just going to show you what that looks like. So basically, this coming, again, if I wasn't clear, for filing this. So the filing status and what deduction. Be aware that if someone's a dependent, such as if your child is working and they're still your dependent, and I have it noted down here. In addition, if any
got kicked off.
Yes.
Yeah, she put someone else in charge. Oh no, she's back.
Okay. So I was saying, these are the standard deductions, and if someone is over 65 and they are married, they can add another $1,550 per person that's over 65. If they happen to be blind and over 65, they get to do it twice. So in other words, if you're married and you're both blind and both over 65, you can add another $6,200 on top of the $29,200. But that's if they are married. If they are not married, if they're single, it would be $1,950 for each instance of over 65 or blind for that person. Next are tax credits. Now, tax credits, as mentioned earlier, are a dollar credit against your tax obligation. Now, there are different types of tax credits. Some are non-refundable, and what that means, they can only be deducted up until the total tax liability. So say you have a tax liability of $10,000 and you have credits of 12, well, you can only take 10. You lose 2,000. And there are some that are refundable, where you can potentially receive a credit beyond your tax liability and receive a refund. And then there's some that are partially refundable. I'm going to give you some criteria for each one of these, and then you'll understand better. So for non-refundable tax credits, some of the more common ones are child and dependent care credit. This is for children, for any expenses incurred for care of a child while you're working. And this can include daycare, camps, before and after care, but they have to be under 13. That means if you're providing care for someone who's 12 in the spring, but then turns 13 in September, well, any expenses up until before September are eligible. But you also have to be aware that you have to balance this with if the taxpayer is actually using a dependent care flexible spending account at work, they do have to reconcile to that. They cannot double dip. Then there's a child tax credit. Sounds very similar, but it's not. So a child tax credit is a credit because you have a child and they're under 17 years of age. And they must be under 17 years of age as of December 31st. So unfortunately, if your child turns 17 in November, they are not qualifying for this credit. Now we'll talk a little later, but now this is partially refundable and we'll talk about that shortly. There is also another dependent credit. What this is if you have dependents on your taxes, whether it be a child or another dependent, and they are over 17 years of age, there is a $500 other dependent credit for that dependent. Again, we need to check the criteria, but that just wants you to know that that is available. There's also an adoption credit. They do provide a credit for the expenses incurred in adoptions. It is not refundable, but this one credit can be carried forward up to 5 years. But again, you need to verify the criteria and check what the rules are. And then there's a tax savers credit. Sounds great. But the tax savers is only for those over 18 are not a dependent or a student. It relates to voluntary contributions to retirement plans. But also know, as great as it sounds, it's to encourage savings towards retirement, but at the same time, it has income limitations. So not everyone can take advantage of it, but it is good to know and be aware of. And then there's education credits. There's two types of education credits, which I'm going to, if I have enough time, I'm going to briefly go through. One is the American Opportunity Tax Credit, and the other is the Lifetime Learning Credit. One thing to be aware of is if the person's dependent, they cannot take them. However, the person who they are dependent of, that taxpayer, if they pay the tuition, can take it. I'm going to race through these. I see we're going to time. Residential energy tax credits are a credit for any energy saving home improvement you make. That includes like certain doors and windows, but it is a percentage of what you spent up until a maximum. So be careful on that. And then if there's an electrical vehicle tax credit. Again, criteria have changed over the years, and not all vehicles will qualify. And also there is income limitations. Next are refundable or partially refundable tax credits. Additional child tax credit. This is where the child tax credit could potentially be refundable. And the only way that happens is if the original child tax credit would have not been able to be fully taken because you didn't have enough tax liability. There is a portion, not the full amount, but there is a portion, another calculation that says that they can still be a refundable credit. The education credits, you'll see it's only one credit is partially, not fully refundable, but a portion of it could be refundable if you did not have a tax liability. There's the earned income credit, which is the one I'm going to focus on, and I have a few slides on that because that's the most common. And then there's premium tax credit. I do want to touch base on this premium tax credit because this relates to your healthcare marketplace insurance that came out of the Affordable Care Act. And what it is if you do have insurance on the marketplace, you will get what's called 1095A at the end. And you will need to enter this on your tax return to reconcile. Sometimes you get a credit and it's more than you should have received or less than you should have received. If it's less than what you should have received, that's when you can get the refundable tax credit. Sadly, if it's more than what you should have received, it will be factored in and you will have to put that into your income. So for the earned income, there are criteria, but I wanted to make you aware it is for earned income. In other words, it doesn't consider the interest or dividends that you had. It's just on earned income. However, despite not including that, you cannot have investment income that's greater than $11,600. There's other criteria here that you can read through. And if you do not have any qualifying children, you must be at least 25 years old or under 65. And it is like a bell curve. So basically, if you make very little, you get a little bit of earned income credit. As you make more, you can get a higher credit. But there's a point where you're making too much, so you can still get the credit, but it becomes less and less as it goes on. Knowing that I do have people here in the military, I wanted to also point out that with the military, there's special rules on non-taxable combat pay. Non-taxable combat pay is when you, as you know, may be in a combat region and it's not taxable. However, when it comes to the earned income credit, you have the option to include it or not include it. And that, why would you include it or not include it? Maybe you're here and adding it will bring you up here. But if it's not beneficial, it's going to bring you further down the curve, you wouldn't include it. So you actually have the option to select. And being that we're short on time, I know I'm going to be pushing a little bit, but here are the limits. This slide will show you that depending on how many qualifying relatives you have and what your filing says, this is the maximum income to claim any credit. It doesn't mean like the more income you have, like I said, that you might actually have a lower credit, but this is the maximum. And then also here's the maximum credit you would receive. And again, when I say maximum, it means you have to, this is the maximum, but it can go down. So education credits, I'm going to briefly go through this, and then I do have a schedule on it, but I can't really go through due to time limits. But Maximum modified gross income is primary for both of them is between 80 and 90,000 unless you marry filing jointly, then it's double. Why the range? The range means that up until this amount, if you qualify for the credit, you'll get the full credit. After this range, you'll get no credit, and in between, you get a portion. You cannot be claimed as a dependent. So again, as I said, if the child's a dependent, the parent can take it, but not the child. Neither one of these credits includes room and board, which is a big chunk. And then here's the criteria for the American Opportunity Tax Credit and the Lifetime Learning Credit. Again, the important thing to know is the American Opportunity Tax Credit is only 4 years post-secondary and includes course materials, must be part-time as well as going towards a degree, whereas Lifetime Learning Credit could be, does not need to be going towards a degree and can be used post 4 years, meaning for graduate school. So here's the schedule of what the different criteria are, how they differ between the two credits, and which credit is best to take. I know, I apologize, I try to keep it within. So a few other things I want to cover before we're done is that you can always amend your tax return. The timeline within to amend it is 3 years from the date it's originally filed or 2 years from when the tax was paid. If you never filed, you may always file if a refund is due. You may always file, but if a refund is due, it cannot be beyond the 3 years. If you owe money, they'll be happy to take it. The IRS, so even though you can only go back 3 years, the IRS has the ability to go back after you for 7 years. So we always suggest not to get rid of your documents for more than with that, before 7 years is up. Now, if you commit fraud, they have no statute of limitations for that. So anyway, I did include in the appendices the tax brackets. You hear about tax brackets. We have a progressive tax system. So even though these are the rates of that we talk about, oh, we're in the 10%, 22% tax bracket, these are the income ranges for each of the different types of filing statuses. I want to show you an example of what that truly means as a progressive tax. So this is illustration purposes only. It's using the married filing joint tax brackets and showing you here that the maximum income at each year, pull that over, here is 2320. That's 10% because basically I'm taking the maximum divided by the total income. Come down to this next bracket, which is a 12% bracket. Well, you only get the tax 12% on the amount over 23,000. You add that to the tax here, the max is $10,000. So your maximum blended rate or effective rate is actually 11.5. Sorry. And so I showed you in each bracket that even at a 35% tax bracket, your maximum effective rate would be less than 27%, just because of the way the progressive tax system works. So I know I had to kind of speed it up a little bit towards the end, but is there any questions?
You have one in the chat.
I do. Earning Kirkwood says the 11,000 reinvestment. So you're talking about basically having done a conversion. I would have to get back to you on that. I would say it should not, but I'd have to double check because it does come into that section of the tax return. But I want to say it does not.